DraftKings has earnings coming up and they have some serious growth expectations, but the underlying story is a little bit more complicated than that. Let's talk about it. Wall Street is expecting 41 cents of EPS, which would be a massive jump from the 12 cents we saw last year. That accounts for a 241% increase year over year. Revenue is expected to come in at about 1.4 billion. That would be a 28% increase year over year. So you can see there's definitely a lot of expectation from the street. Now, DraftKings actually guided for more than 200 million in adjusted EBITDA, which is up from 120 million that we saw in 2024, which is great news. But the underlying issue, DraftKings did lower their full year forecast. They dropped that full year revenue guidance from 6.45 billion down to 6.3 billion, and they dropped their EBITDA full year guidance from 950 to 850 million. Now, their cited reason for this lower guidance is repeated customer-friendly outcomes with regard to March Madness and the NFL playoff. Stock remains just about 7% up year to date, which is trailing the S&P and trading right near a serious point of resistance in their stock price. DraftKings earnings could tell us a lot, but with the recent revised guidance, regulatory pressures, and the massive short interest on the stock, I don't expect it to be smooth sailing for the next quarter in DraftKings stock.